Social Security taxation is all kinds of wonky, and claiming Social Security benefits is all kind of complex. So when we merge the two together, we're going to have lots of fun today. We'll be talking through when you might want to think about your taxation status as you claim your Social Security benefits and when it's really not going to matter.
Okay, so Spencer, in the past, we've done videos about Social Security calculation, how it's taxed, all of that. We're not going to necessarily dive deep into provisional income today, but what are we talking about?
Yeah, so we're talking today about those complex elements, how Social Security is taxed, when you claim those benefits, how those come together. And so just as a quick reminder, if we think about Social Security benefits, we get some kind of a tax break from the government on those. Only 85% of those benefits at the high level can be brought in as ordinary income. Now, on the low side of things, it can be much, much lower. And so it's kind of one of these areas where we might have very, very low taxation of those benefits, or we might have kind of average taxation of those benefits. And that can impact on some edge cases when we should claim those benefits. If we claim the benefits earlier, in some circumstances, we may have lower levels of taxation, which means our net benefits are actually higher, and it might influence us to take those benefits earlier. In contrast, sometimes it would be much better if we defer taking those Social Security benefits because the tax advantage is going to help us in that deferral. And we want to walk through a few of those scenarios today.
Yeah. So I think one thing that oftentimes trips people up is they think, okay, I've got $40,000 of Social Security. That's all going to be included in ordinary income. How does that actually pan out? Just give us a broad overview.
So big picture, again, on the low side of things, let's say you're married filing joint and you have a bunch of assets in the bank, you file for Social Security benefits and you're getting very low levels of income. Let's say you're only getting $5 of interest in the non-qualified accounts that you have. So you have basically no other income outside of that $40,000 of income and you're married filing joint. Good news, none of that is actually going to probably be taxed because even the amount that you have there, the provisional income is only $20,000 because that is half of your Social Security benefits. So $0 would be included in your ordinary income there. Now let's flip over to a different scenario. Let's say you have a really nice pension, $100,000 a year. Well, 85% of the Social Security benefits that you have in that scenario are going to be brought in to be taxed as ordinary income. So $34,000 there. So you still have a little bit of that income from Social Security that's not being taxed, but generally speaking, you can kind of account for all of that almost being taxed.
Right. So as we think about it just practically, in that second scenario, you've got a $100,000 pension, $40,000 of Social Security. You don't have $140,000 of taxable income. You've got $134,000.
Right.
And so only a little bit of Social Security is going to be included as your ordinary income in that tax calculation.
Right.
And I think that's where the confusion comes in is how much of it is included, how much is it not included? So just wanted to clarify that.
Yeah, and on the other side of things, $40,000 of income, well, zero of that goes to your taxable income there. So it can vary there, and that's why we want to have our talk today. Generally speaking, this is also, we think about the choices that you have as filing for benefits. If all of your people, your parents, your grandparents, if they're all living to 100 or longer, you probably need to defer your Social Security benefits because it's going to be in your best interest. If you have had health events and you're not likely to live beyond 75, you probably want to take Social Security as early as you can. So we want to talk about those cases where people may have a life expectancy that's in the low to mid 80s. Now, for most of the clients that we sit down with, if they are in good health and they're, say, in their mid 60s, we're going to project out that they're probably one spouse or another, if we're working with a couple, is going to live into their mid 90s. Statistically, that's what we would look at from actuarial tables. If we have a single person, then we're looking kind of early 90s in that typical trajectory again. And that's about 5 years longer than what we would say the average US population is. But the people that we serve tend to have better access to healthcare, have saved better, and have a higher level of education, which all of that stacks towards a higher longevity. So as we think about this, again, people who live longer probably defer. People who have a shorter life expectancy probably claim earlier. But it's those folks that maybe you've had a moderate to minor health event, and you think, well, maybe my life expectancy is low to mid 80s there, that this would really, some of these decisions would really be important to consider the taxation side of things.
So Spencer, we've talked about the longevity factor. We've talked about just kind of the base idea of how Social Security is taxed. So as we think about this on an income projection, how does that affect Social Security taxation and timing?
Well, we think about two factors. One is the amount of income external to Social Security, and one is kind of the balance between Social Security and that external income. So again, if you are married filing joint, you have pension income, or you have overall income that would include like non-qualified dividends, even taxable interest and tax-free interest for that matter. All of these different pieces coming together that would affect Social Security, if that is at least $100,000 of income and you're married filing joint, it's really not going to matter when you file with respect to taxation. That's going to outweigh this filing decision. On the other side of things, if we looked at married filing joint folks, and if you don't have hardly any income outside of Social Security, why that Social Security filing decision is going to be fairly straightforward to you. You just look at your longevity and when you can take those benefits, and it's really much less about taxation on that side of things too. So the high side, again, for married filing joint, about $100,000 of income outside, you don't need to worry about it. If you're a single filer, it's about $60,000 of income. North of that, you really don't need to worry about Social Security taxation, because your Social Security benefits are going to be drawn in with a full level of taxation in all likelihood. Again, same thing, if you're a single filer, have much lower assets or lower income outside of Social Security, it's a pretty straightforward decision. You just take when you need to.
So Spencer, we've talked longevity, we've talked income. How bad can the tax really be?
Yeah, well, we'll put in a table here to kind of show you this that we think helps to give clarity. But it can be pretty bad, actually. Again, we're deferring taxation, or we're not getting taxed on a lot of the income that maybe we typically would. Social Security and that provisional income calculation, it's not being added to our ordinary income tax for a while. But then when it starts to get added, there's like this catch up, so you could say it's a kind of a shadow tax, not anything nefarious, but there's just kind of this shadow taxation where for every additional level of income, you get hit with ordinary income tax, but then you also bring some of that Social Security income in as well. So for every additional level of income there, $1, it actually kind of feels like $1.85 in some circumstances. So just to give you some frame of reference, if you're at the 12% tax bracket, and for every additional dollar of income, you are getting pulled 85 cents of Social Security income in, then your tax rate would be 22.2%. So you have the 12% that you're being taxed on, and then 85% of another 12. So that ends up being 10.2%. So those two together, 22.2%. Now that's not bad. Where it gets nasty is when you're already at the 22% tax bracket, and every additional level of income, every additional dollar of income, we have 85 cents of Social Security income coming in with that. So we have $1.85 basically of income for every dollar that we're actually receiving, and we're taxed at a 22% rate. What that equates to is a tax rate on that area of 40.7% just at a federal level. So again, it's benefit that we didn't have taxed, earlier in that pay scale that now we're making up for, but we'd like to avoid it if we could. Now, again, if you have $100,000 of pension income, we're not going to be able to avoid that. But in a lot of circumstances, if we plan this well, we can actually think through it and get around it.
Yeah, thanks for walking us through that. Okay, let's go ahead and dive into some of these actual scenarios. So these are all fictional scenarios, hypotheticals, but it kind of helps gather a greater understanding of this tax ramification. So you want to walk us through that first situation. We got 2 for deferring and then 2 for claiming early. Let's go ahead and start with the deferral situations.
Yeah. So a deferral situation where you would want to defer your Social Security benefits, it would be a better tax situation for you. This comes around when we look at trying to increase that level of benefit relative to the other level of income. So one scenario would be, let's just say that we've got Joe and his wife Flo, being really creative with names today. Joe and Flo have $2 million in IRA assets and $1 million in non-qualified assets, and they need $120,000 a year to live on. Well, what they could do if they're age, again, 62, they could claim Social Security benefits, but what would be more strategic in that situation is actually to use those non-qualified resources, use those over time. They might need to take out $120,000 or so of those on an annual basis, but then also do some Roth conversions so that down the road, their income is going to be less that they're going to have to convert. So it might be that they convert several $100,000 with Roth conversions there so that when their required minimum distributions come out, at age 73 in this circumstance, they are not going to have to have as high income there, and their Social Security will be much higher so that not all of their Social Security benefits will be taxed there, or not as much as could be taxed otherwise. So that can be a really, really strong benefit. Let's just say they ended up with $100,000 of Social Security income. From a provisional income standpoint, that might only be $50,000, and then they've only got $11,000 of Social Security income being drawn into their ordinary income. So they could have a tax bill of zero on that income if they do some using of that non-qualified resources up front and then do some aggressive Roth conversions. So that can make a huge difference down the road for folks like this.
Yeah, that's great. And especially I think as we think about tax brackets where they are right now, we don't know where they're headed in the future, but if we're going to step up from 12 to 15%, from 22 to 25%, then it can make a lot of sense to convert while it's low and then defer and get our Social Security taxed almost at nothing. There's multiple benefits there. So let's walk through that second situation. You're deferring Social Security, living on a higher level of IRA withdrawals than you'll have in the future. So walk us through that one.
Right. This is kind of just like Joe and Flo's scenario. We'll call this Joe and Flo 2. They don't have $1 million in non-qualified resources. What they're doing instead, they're living off of the IRA. So they're taking these distributions up front, and so they might need to be taking, something like $140,000, $150,000 maybe even from their IRA over a span of 8 years from age 62 to 70 so they can defer those benefits and allow them to step up. Well, again, taxes are lower, as you mentioned right now, at least as we sit. But even if they step back up in 2026 after the Tax Cuts and Jobs Act should sunset, they're going to still be in a situation where they are taking those distributions, not having terribly high level of taxes, and then down the road, not having much of their Social Security income included in their taxable income. So the same type of scenario, we're just using those IRA resources. Instead of doing Roth conversions, we're using them to take as distributions. And what that allows us to do is to lower that required minimum distribution in the same kind of fashion where it might be very low once they get to age 73.
Right. And this would presume that Social Security is going to cover a lion's share of their living expenses at that time.
Absolutely. So we would see a scenario oftentimes if we had one spouse or the other that had a maximum level of earning and they're age 62 right now, they might have benefits that are close to $5,000, in today's dollars, and have a spousal benefit that would be a little bit less than half of that. So we're talking $6,500, maybe on a month-to-month basis. You run that forward with some inflation over an 8-year time frame. They may have over $100,000 of income once they turn 70, which would be a lion's share of really what they need.
Right. Okay. That's really helpful. So we've talked through deferral.
Right. Let's
go ahead and talk early claiming. We got, again, 2 scenarios here. Let's go ahead and talk about the first one. Not enough non-qualified accounts to supplement income, and you have a lot in IRA. So walk us through this third situation.
So this third scenario actually is not too dissimilar from our original Joe and Flo scenario, but they're just approaching it in a little bit different way. And what we could almost say in this is we either want to be very hot or very cold with respect to claiming. We don't want to be somewhere in between. So in this scenario, we have a couple who has $500,000 in a non-qualified account. They have really high level of pre-tax resources in IRA and 401k. Let's just say they have $5 million, that's sitting there. So they know they're going to have required minimum distributions that they can't really get around. They can't do Roth conversions around this. So what they could do, again, is they could claim earlier here and they could supplement with some of those non-qualified resources. So if they claim earlier and they have very little income outside of maybe a little bit of interest in those non-qualified resources, what they may end up with is, let's just say in this scenario, $5,000 on a month-to-month basis that they are using from Social Security, so $60,000 a year. Let's just say they have $500,000, and so they have a modest amount of income there if they're keeping it in the bank because they know that they're going to use it over the next few years. Let's say they supplement their Social Security income with $40,000 of resources from the bank. So they've got $100,000 to use here. Well, what we find in that scenario is that the Social Security income is not taxed at a high level at all. Because again, $60,000, if we take half of that, that's $30,000 of provisional income. Let's just say we have $10,000, $15,000, of income from interest, in the bank, have a very, very low level of Social Security taxation there. Just a small amount of their Social Security benefits being included as ordinary income. And it doesn't get even to a level above that standard deduction as we see right now. So effectively would have no tax, in a circumstance like this between a low level of Social Security benefits being included as taxable income and a reasonable standard deduction there.
All right, so let's talk about this last early claiming strategy. You've got someone that has a deferred pension or income stream that's going to start 70 or beyond, or maybe some deferred capital gains that they've got to take after age 70. Walk us through that situation.
Well, this could be a situation with a lot of different scenarios. You could have a sale of a business that is paid out via installments that might be deferred. You could have a deferred pension. You could have a deferred annuity. You could have a lot of different types of deferrals. Real estate that you plan to sell somewhere around age 70 or 75 that is going to have a capital gain associated there. So if you take Social Security benefits before any of those hit and you're using that as a significant piece of your income, you may have no taxation on that benefit up until that point that you trigger that long-term capital gain, you get the installment sale from your business, whatever it might be there. So something certainly to consider.
Yeah.
At the end of the day, there's thousands of different situations for Social Security claiming strategies. You've got to think a little bit about taxes, a lot about longevity, and really a whole lot about how this fits into your financial plan. We'd love to talk with you about that. If you have questions about this, if you're working with another financial advisor, make sure that you talk with them about this. Get this incorporated in your financial planning process. And we wish you the best until we see you next time.
If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.